With the bonus depreciation, you can deduct a large percentage and sometimes up to like 60 or 80% of those short-term assets in the first year. And the tax law changing every single year. And later on, I will talk about the one big beautiful bill that came up this year and how we can use that bonus depreciation to help our tax client.
All right.
Righty.
Well, welcome to Breaking Ground Commercial Real Estate Podcast, the show where big ideas meet real opportunities. Here, you'll find conversations that inspire, educate, and empower. Whether it's turning dreams into reality, building smarter investments, or finding the right space for your vision. I'm Kennya Sanchez, and I love helping individuals and investors bring their vision to life, finding the space where dreams truly become reality.
And everyone, my name is Thao Nguyen, and I help people build generational wealth through real estate investment.
Today's episode is all about one of the most misunderstood tax advantages in real estate. How real estate investors legally pay little to no taxes using depreciation. And joining us is our special guest, Kyle Truong, an enrolled agent and founder of An Khang Services, a firm specializing in tax planning, insurance, and business advisory. Kyle is not just a tax professional. He's a financial strategist who has helped hundreds of clients nationwide navigate the complex U.S. tax system. Truong and Khang Services, he provides full spectrum advisory in tax preparation, real estate planning, insurance solutions, business formation, and investment strategy. What makes Kyle stand out is his ability to translate complicated IRS code into practical real-world applications. His approach isn't just about filing taxes. It's about building financial freedom through smart tax planning. He's worked with everyone from first-time property owners to multi-unit investors, helping them understand how to use legal tax incentives like depreciation and cost segregation to build long-term wealth. Kyle, it's a pleasure to have you on our show today. Thank you so much, and welcome to Breaking Ground.
Thank you so much, Kenya, for having me today. And hello to everyone. It's such an honor to be here with you guys today with Breaking Grounds, and let's get started.
Yes, we had some good feedback in the back end earlier of doing business and connecting internationally, so that was super awesome. But let's start with something simple. What exactly is depreciation, and why does it matter?
It's actually a pretty great question. So depreciation, the simplest way to understand it is actually how the IRS recognize your property. So for example, the building itself is wear off over times, right? So they allowed you to deduct a portion of the building values every single year, even it's actually appreciating in the market value. So, for example, residential you can depreciate over 27.5 years, and otherwise commercial is over 39 years. So that means even through your real estate is generating the cash flow, you are allowed to report on paper loss that reduce or eliminate your taxable income. And that's how investor can pay very, very little or nothing in taxes legally.
So that is where the bonus depreciation and cost segregation comes in as well, right?
Yes, exactly. So for cost segregation, it's like dissecting your property. For example, if you treat like your whole assets as like a 27.5 years assets, we can identify the component that depreciate that faster, such as flooring, lighting, applicants, and landscaping. So those can be depreciated over 5, 7, or even 15 years. It doesn't have to be 27.5 years. Uh, yeah. So then with the bonus depreciation, you can deduct a large percentage and sometimes up to like 60 or 80% of those short-term assets in the first year. And the tax law changing every single year. And later on, I will talk about the one big beautiful bill that came up this year, and how we can use that bonus depreciation to help our tax client. And so, for example, when you buy like a million dollar building, um, you can do a cost study of it and reclassify 250,000 that into a short-term assets. And with the tool bonus depreciation, you can able to deduct that 250,000 immediately, and that is gonna be like a huge paper loss to offset your real profit.
Wow. And what are the pros and cons of bonus depreciation? If we depreciate 100% in the first year, will it leave us nothing to depreciate in the coming years?
Yes. So the pros of the bonus depreciation, you can take immediate tax saving, improve your cash flow, no annual limit, applies to new and used property. And on the other hand, on the cons that you were talking about, um, of course, when you take a big chunk of deduction already in your current year, right, there is no further depreciation deduction. And also, when your income spike to like really high each year, it's gonna create like an uneven pattern of your tax report, right, on your tax return. And it's also reduced the book value of the property, and later on you will have to recapture when you sell it, which means that the amount that you depreciate the value is gonna capture at ordinary how do I say this? I'm sorry, ordinary income. Yes. So later on, when the investors sell the property, it's gonna be taxed at ordinary income. I cannot say this word today.
Right. There's days that you get the words, that's me.
Yes, but also it's also not the best when lenders looking at your income for the gross business if you want to use that business to use for apply for business loan. But usually the depreciated amount can plus back if you record it correctly. So when lender looking at it, they know how to count that back as your income on there to qualify.
And you help with that piece, right? Say somebody has purchased the property and they're looking to get a loan. You help with all that process if they explain to you what their vision is.
Yes, so it's very important that, especially like if you want to buy like a property, like commercial one, like 1 million or 2 million, your balance sheet and your like the tax return needs to be really clean. It's gonna have no flaws into it. So right, so you have to do the bookkeeping, also record all of the records, the value, the financial, to help the lender to see that you actually qualify for it. So usually we plan for clients and do business loan consultant as well. How like we know how the lender want what on your tax return would be able to qualify for the loan. So it's not like a 1 month process to be done. It's have to done throughout like really good tax planning and good record of the bookkeeping as well.
Okay.
Mhm.
So for example, before they want to do the bonus depreciation of the whole 100%, do they go talk to you, their financials advisor, their accountant, and say, hey, I want to do 100% bonus depreciation. Do I have as much as enough at the tax to be able to use it efficiently so that they won't like waste a portion of that? You know what I mean?
Yes. So I understand your questions, Tao. So basically, before that any depreciation can take place, right? We will need to also review their financial income, for example. So you don't want to create like a spike pattern that this year your income is really low due to able to take like a chunk off, and then next year you don't have anything to to deduct, right? So we need to really taking care of seeing the other tax return and how also do like a cost study of their commercial building or their rental property, and is it really worth it, or is there any, are they planning to sell that in like 5 or 6 years, in the next 5 or 6 years, because later on they will have to recapture that one. And if they don't plan it very well, they're gonna end up like paying a lot more taxes when they exit the strategy for bonus depreciation. So that meaning that we need to sit down, talk to them, find out their plans, what are they planning to do, and try to get like all of the information to in order to advise for them what is the best way.
Okay.
Mhm.
So the investors still can make they are still making the money. It's just showing that they have a loss on the paper, but they are still making money. They still have
Yeah.
cash flow. They still have enough of the capital to run their businesses. It's just that but they have a smart tax strategy that they are putting on the paper.
Yes, but also I need to address that for in order to for basically rental income or passive income, right? You cannot offset other income if they have beside the rental business they have other business like W-2 or like another company that's generating other income. So the loss that we are talking about on there, it's just a paper loss. But you cannot let passive income to offset other income unless you are a real estate professional. Okay, real estate professional like you guys have realtor license, right? You automatically qualify as real estate professional. But on the other hand, if the clients they have to document their paper, they have to dedicate up to 750 hours per year into the rental business to actually qualify under that real estate professional. And it's very tricky. Like, for example, I am an EA, right? I work mostly with being a tax profession already, and now like adding another realtor license doesn't make me qualify because I make more money on my tax income, on my tax job rather than the realtor income. So I would not qualify for that. So it's really important that the client understand the requirement in order for them to use depreciation to offset their other income. It's creating like a deduction for them, right? So it's lower the taxable amount.
Okay. Being that it's towards the end of the year, when is the best time to buy investment properties and file depreciation for tax year 2025? Is it still a good time, or should people wait till the beginning of the year?
It's actually pretty great questions. Like I mentioned before about the One Big Beautiful Bill Act from Mr. President Trump this year. So the 100% bonus depreciation rate is back for the qualified property that placed in service after January 19 of this year on 2025. So any property that placed that in before January 19, it will not be able to qualify for the 100% depreciation. So if the client right now, if they see, oh, their income are too high right now, right? Then if they're thinking about invest in real estate for rental, they can take advantage of that 100% bonus depreciation rate right now for 2025. But it will need to be done with a cost study of their rental value property, because we have something that in paper that we have to have actually a cost study or for cost segregation to back up for if the client's in audit or something like that. So we need to have like paper records, everything ready.
So we do the depreciation, and will that losses ever trigger an audit? And how can the investor protect themselves while still maximizing the deduction and profit and being clear on their paper? The audit part is really tricky.
Yes, when it comes to audit, there's no way that we could know, but we always able to avoid what causing to trigger it. Okay, so for example, it's audit for depreciation is very rarely, because it is not automatic, like the system does not really detect it. But the thing is, for if something like if you take like a large loss from passive activity, that's gonna trigger, right? And also like aggressive bonus depreciate or cost segregation, then the IRS kind of red flag that as well. Or incorrect, for example, like I said, for a property, we can break it down to different assets, right? To able to take the bonus depreciation. And if we classify that assets incorrectly for their lifetime, it can also trigger. So, and I have seen a lot. This is the most thing I see when I see other people, other tax return. They depreciate non-business use property. So, like for example, like a household only have one car, right? And they putting that car into their tax return and for business use. That doesn't work. That doesn't work, because like on the tax return, it specifically asks you and your wife have another car to use for when you're not on duty for your work, and then they tick that as a no, and they're using the same car for their both business and their household. So that's the most thing that I see that will trigger the audit.
Yeah, so that's really a lot of questions to be able to clarify, because you are preparing their tax return, you are preparing their financials, and if anything is incorrectly recorded, you will be in trouble as well, and not only them, but also your license and stuff like that. So that means a lot that you are helping the clients not only understanding their businesses, but also understanding what they can do and what they should not do in order to maintain their businesses, having doing the business the correct way, the legal way. So thank you for that.
Yes, thank you, Thao.
Okay, now let's go back to the question. Sorry, I just random question that pop up in my mind.
I'm sure a lot of people have a question, Thao, and unfortunately, no. Now you have to invite me so we can make it more into a business meeting. Well, Kyle, what about can real estate investors also use Section 179 to deduct improvements like equipment or short-term assets?
Yes, actually, very great question. So, Section 179 was originally designed for businesses, but in certain cases, real estate investor can be benefit as well, especially if you are operating like, kind of like a rental property as an active business, not passive. I have to state it that not passive twice because for you remember how I was telling about the real estate profession, the difference between just normal people and real estate profession, right? So it's really because real estate profession can that income is gonna be non-passive income. So they're able to offset other business income, right? So, for example, furniture, office equipment, or even HVAC system for the rental operation might be qualified for immediate write-off under Section 179. And also combining with the bonus depreciation, and you can write off like a large chunk of your investment in 1 year. But there is something that there is a limit to it. For example, if you're taking Section 179 and you create off the losses, but the income that you are generating is limit to that income. It cannot bypass to the negative. For example, if you make like a 100K income, right? You cannot take the loss more than 100K.
Okay.
So yes, so that is one of the limitation for when applying Section 179. It cannot be over what you're making. Okay.
Are there any limits or IRS rules that the investor need to be aware of when stacking bonus depreciation, Section 129, and cost segregation all together?
Okay, so let's break it down a little bit. For especially 179, the tax law changed it every single year. So in 2025, I'm just gonna tell the most recent limit for it. Okay, so for Section 179, it says 2.5 million for the property that placed in service in 2025. And the threshold amount that it will fade out dollar by dollar is 4 million. For example, if your income make more than 4 million, that deduction gonna be phased out dollar by dollar when that total amount of qualified property you able to get the deduction from. So and also for the bonus depreciation. One of the things that keep in mind about the January 19 of 2025, any of the rental properties or commercial placed in service before that, it's actually you have to apply the old bonus depreciation. You cannot apply the 100% like after the with the one big beautiful bills. Okay, and very important for cost segregation, you have to have backup materials. Always, you have to have backup materials. Like you have to pay for that cost study from like a engineer tax company because gonna have like a CPA who specialize in classify those assets to sign off on your cost study paper. Okay, and then you're gonna take that, keep that, put that into your tax return. And in case of audit, right, you have the paper, you have to pay. This was actually not done by me; it's done by a third party. That uh, that you have backup material to prove that to our IRS. You are not like, just input some random numbers in there. It's have to be a certified engineer tax CPA who able to sign off on that for you.
Wow. Okay.
Yes.
Well, and what about for new investors just starting? Is it better to buy old properties or in order to get more depreciation benefits, or newer properties with fewer immediate write-offs?
Um, it really depends. So for old property, right? You, of course, when you take over old property, you're gonna have to do a little bit of improvement to that before you can rent it out, right? You can deduct it, like use the bonus depreciation and stuff like that. And on the other hand, on the new property, there's less thing to deduct or to dissect it from it. So, but it's gonna in the next couple years, you have like a stable kind of like depreciation, like kind of like a straight line. So it's really depend. So I don't really give advice to either they should buy like a new or old. Each situation is it depends on their goals and their plan. So and then I don't think I'm certified to advise on that. That's more of you guys think,
Yes.
right?
Okay.
So the big takeaway here is depreciation isn't just about wear and tear, but it's really smart tax strategy, isn't it?
Yes. So when you deeply understand depreciation, cost segregation, and the strategy of Section 179, you will know how other investors keep them more money in their pocket while their properties still appreciate in the value. It's actually a very good tax strategy, but you have to plan it very carefully because in the end you don't you are creating a tax strategy but you don't have an end point to it. You don't have an exit door. So make sure that for when you're planning it, your tax accountant or whoever tax planner that you're working with, you have to ask for an exit plan. Okay, and I think that maybe next time we have more time, I will share about the exit door that I just mentioned.
Yeah, that would be amazing.
Yes.
Well, thank you so much for your time today and for sharing so much valuable information. Do you want to take a moment and just tell us a little bit about all the services that you provide and where people can find you?
Yes. So our firm is located on 2408 West Walnut Street in Garland, Texas, zip code 75042. And we specialize in tax planning, file income tax return, bookkeeping, and payroll, and also audit. IRS audit representation. So if you ever have problems, just give us a call.
Great.
And our phone number is 564-234-6868.
Well, thank you so much. And definitely, we look forward to speaking with you again and talking about more strategies, including the exit strategy that you just mentioned.
Yes. All right. Thank you so much, Kenya. And thank you, Thao, for inviting me to this meeting. I hope that it's helped your client to understand more. And I'm looking forward to get more sections like this with you guys.
Yes. And I just want to mention that you do work with international clients.
Yes. I do. I do. Yes.
Great.
All
Well,
right.
until next time, keep learning, keep investing, and keep more of what you earn. Make sure you join us. Thank you so much.
Yes. All right. Thank you. Bye, everyone.